The market never announces accumulation, it disguises it. Strong hands do not chase price, they absorb supply quietly while the public grows impatient. Until these footprints appear, trading is mere speculation. For example, price holds firm despite repeated sell pressure, spreads narrow, volume contracts on reactions, and demand expands only on advances. These are not coincidences, they are confirmations. Until you see them, you wait. When a market refuses to go down, despite every apparent reason for it to do so, the student of tape reading should immediately become attentive. This behavior is never accidental. Price does not resist decline by chance. It does so because opposing forces are at work beneath the surface, forces unseen by the casual observer, yet unmistakable to the trained eye. In a weak market, selling pressure expresses itself with ease. Price breaks, supports readily, reactions are sharp, and each rally is swiftly met with renewed supply. But during periods of accumulation, this natural order is reversed. Supply is not absent, it is present and often persistent, but it is being absorbed. Large interests, whom I have often referred to as the composite operator, are quietly taking stock from weak holders. They do not announce their intentions. Their business requires patience, discretion, and concealment. Observe, therefore, what happens when price is pressed downward repeatedly and yet fails to make meaningful progress. The public interprets this as indecision or lack of interest. The professional recognizes it as strength. Each downward thrust that fails is a test. Each test that holds is evidence that supply is being met, matched, and ultimately neutralized by informed demand. This resistance to decline is frequently accompanied by discouraging news, bearish opinion, or a general sense of fatigue among participants. Such conditions are ideal for accumulation. The operator desires stock, not attention. If price were to advance prematurely, it would invite competition and increase cost. Thus, price is held within a narrow range while the work of absorption continues. You will often see wide effort, heavy volume produce little or no downward result. This is one of the most revealing signs of all. Effort without result indicates opposition. The selling is real, yet its effect is limited. Where does that supply go? It must be going into stronger hands. There is no other logical conclusion. As this process unfolds, reactions become less effective. Supports that should break do not. Each subsequent decline travels a shorter distance and meets buying sooner than the last. The market is telling its story plainly to those who listen. It is becoming increasingly difficult to force price lower. The student must discipline himself to wait for this condition. To act before price demonstrates its inability to decline is to act on hope rather than evidence. Professional trading begins not with anticipation, but with confirmation. Until the market proves that it cannot go down, one has no justification for assuming it will go up. Remember this principle well. Weakness is easy. Strength requires effort. When the market absorbs effort without yielding ground, it is preparing not to drift, but to advance. The informed operator is not guessing at this moment. He is reading it directly from the behavior of price itself. One of the most reliable indications that a market is passing from weak hands into strong is found not in what happens on advances, but in what occurs during reactions. The public is inclined to focus its attention upon rallies, yet it is in the pullbacks that the true condition of supply is revealed. Volume, when properly interpreted, is the language through which this condition is expressed. In a declining or distributive market, reactions are accompanied by expanding volume. Selling is eager, emotional, and persistent. Each rally invites further liquidation, and each decline is reinforced by increased participation. But in the process of accumulation, this behavior changes subtly and then decisively. Reactions occur on diminishing volume, indicating that the supply of stock available at lower prices is steadily being exhausted. This contraction of volume is not accidental, nor is it the result of disinterest. On the contrary, It reflects the success of previous absorption. The composite operator, having already taken a substantial line of stock, no longer finds much supply offered on setbacks. Weak holders who sell from fear or impatience have largely been eliminated. Those who remain are either informed or unwilling to part with their holdings at unfavorable prices. As price declines within the trading range, observe carefully the character of the volume. Each successive reaction should show less effort. The market drifts downward rather than falls. Spreads narrow, price bars overlap, and the sense of urgency disappears. These are not signs of weakness, as the public often believes, but of control. The market is no longer being driven by sellers. This principle must be understood in connection with the law of supply and demand. When supply is abundant, it reveals itself readily. When it is scarce, price must be coaxed lower with increasing difficulty. Thus, diminishing volume on reactions is the market's admission that supply has been absorbed or is in the process of being absorbed by stronger interests. It is important to note that reactions will still occur during accumulation. The operator does not prevent declines entirely, nor does he seek to maintain constant upward progress. His objective is to test the market. Each reaction serves as an inquiry. How much supply remains? When price retreats on light volume and quickly finds support, the answer becomes increasingly clear: very little. The untrained trader often mistakes these quiet pullbacks for distribution or lack of sponsorship. He sees price drifting lower and assumes danger. The professional sees something quite different: the absence of selling pressure. Where there is no pressure, there can be no serious decline. As accumulation matures, these low-volume reactions become shorter and more shallow. The market begins to show a preference for higher levels, even though it has not yet committed to an advance. This reluctance to decline is one of the clearest signs that preparation is nearing completion. The student must resist the temptation to anticipate. Diminishing volume on reactions is a condition, not a signal. It tells you that selling is losing its power, not that buying should commence immediately. Only when this condition is followed by an expansion of demand on advances does the opportunity become actionable. In all market study, remember this: volume measures effort and price measures result. When reactions show less and less effort, the result becomes inevitable. The market, having rid itself of supply, is quietly preparing to move in the only remaining direction upward. When the market is under accumulation, advances do not occur by accident, nor are they the product of enthusiasm alone. They are deliberate demonstrations of strength. One of the clearest evidences that demand has assumed control is found in the character of upward price movement, specifically in the widening of spreads accompanied by increased volume on advances. In a weak market, rallies are labored affairs. Price advances only with difficulty, spreads remain narrow, and volume fails to expand meaningfully. Such rallies are easily reversed, for they are supported more by hope than by genuine buying power. But in a market where accumulation has progressed, this condition changes. When demand appears, it does so decisively. Observe carefully what occurs when price begins to advance from within a trading range. If spreads widen, closes occur near the highs, and volume increases relative to prior rallies, you are witnessing not a temporary reaction, but the emergence of strength. This expansion of both effort and result is the market's announcement that buyers are now willing to compete for stock at higher levels. The public often misinterprets increased volume on advances as late participation. The professional understands that it is necessary. A market cannot rise without demand, and demand reveals itself through expanding volume. The critical distinction lies in where this volume appears. When it emerges after a prolonged period of absorption, particularly following low-volume reactions, it is evidence of intent, not exhaustion. The composite operator does not mark prices up impulsively. He first ensures that supply is sufficiently reduced. When this condition is met, advances become easier. Resistance that previously halted rallies now yields. Price moves upward with less opposition, and this freedom of movement is reflected in wider spreads. Note also the quality of the advance. Strong markets close well off the lows and frequently near the top of the bar. This indicates persistent buying throughout the period, rather than a last-minute effort. Such action tells us that demand is not merely present, it is dominant. Another important feature is the contrast with prior rallies. Earlier advances within the range may have failed on narrow spreads and light volume. The change in behavior is the signal. Markets repeat patterns until they do not. When the character of the rally shifts, the underlying condition has changed. This expansion on advances must be viewed in relation to reactions. If advances show widening spreads and increasing volume, while reactions remain shallow and light, the balance of power is clearly shifting. Demand is exerting itself with growing confidence, while supply is increasingly passive. The student should understand that this sign does not stand alone. Expanding spread and volume on advances confirms earlier indications of strength, resistance to decline, and diminishing volume on reactions. Together, they form a sequence, not a coincidence. Many traders err by attempting to buy weakness. The professional waits for strength. He recognizes that strength must prove itself before it can be trusted. When price advances easily, with authority and volume, it is demonstrating that the market is prepared for higher levels. Remember always, accumulation is preparation, markup is expression. Expanding spreads and volume on advances mark the transition between the two. When this sign appears in proper context, the market is no longer whispering its intentions, it is speaking plainly to those trained to listen. In the study of market behavior, tests are among the most purposeful actions undertaken by professional interests. They are not random movements, nor are they designed for the comfort of the public. A test is an inquiry, an experiment conducted by informed operators to determine whether any significant supply remains. When these tests result in higher lows, the market is revealing a condition of growing strength. During accumulation, price is repeatedly pressed downward toward areas where supply previously appeared. The object is simple: to discover whether sellers are still willing or even able to offer stock at those levels. If supply is present, price will fall readily and remain depressed. If supply has been absorbed, the decline will be brief, shallow, and quickly arrested. A higher low, following a test, indicates precisely this latter condition. Price attempts to revisit prior support but fails to reach it. The market turns upward sooner than before. This is not the result of enthusiasm, it is the result of scarcity. There is insufficient stock offered to permit a deeper decline. The untrained observer often misreads this behavior. He sees price failing to return to the bottom of the range and assumes danger that the market has gone too far or is becoming unstable. The professional understands that this inability to decline is the very definition of strength. Each test that produces a higher low reduces uncertainty. It tells us that selling pressure has weakened further since the last examination. Weak holders have been eliminated. Those who remain are either strong hands or are waiting for higher prices before selling. Both conditions are favorable to an advance. It is important to observe not only the price level of the test, but also its character. Higher lows are most meaningful when they occur on reduced volume and narrow spreads. This combination signifies that the downward effort was minimal and that price stopped declining due to lack of supply, not because of aggressive buying. As accumulation progresses, these higher lows often form a subtle upward tilt within the trading range. This should not be mistaken for a premature trend. Rather, it is a sign that the market is becoming increasingly uncomfortable at lower levels. Demand is quietly asserting control without yet forcing a decisive breakout. The composite operator relies heavily on these tests. They serve as confirmation that his campaign has been effective. Only after repeated tests fail to uncover supply does he allow price to advance more freely. Until that point, patience is required. For the trader, this sign is invaluable, but only when properly interpreted. A single higher low proves little. A series of higher lows, each following a deliberate test and accompanied by diminishing volume, establishes a condition. It tells you that risk is contracting and that the market is preparing for a change of state. Yet, I must caution the student. Higher lows are not an invitation to act prematurely. They indicate preparation, not execution. The market must still demonstrate strength through expanding demand and structural confirmation. Remember this well. Markets rise not because they are pushed upward, but because they can no longer be pushed downward. Higher lows after tests are the footprints of that truth. They mark the point at which supply has lost its authority and demand, though still quiet, is preparing to take command. One of the most fundamental principles upon which all sound market analysis rests is the proper interpretation of effort and result. Volume represents effort, price movement represents result. When these two are in harmony, the market is behaving normally. When they are in conflict, the market is revealing the presence of opposing forces, and it is here that the professional finds his greatest advantage. During the process of accumulation, it is common to observe periods where substantial selling effort produces little or no downward result. This condition is neither accidental nor insignificant. It is evidence that the selling pressure is being absorbed by stronger interests who are willing to take the stock being offered without allowing price to decline materially. Consider what this means in practical terms. If heavy volume appears on a downward movement and price fails to extend that movement, if spreads narrow, progress stalls, or the market quickly recovers, then the effort has failed to achieve its intended result. Such failure can occur only when demand is present in sufficient quantity to offset the supply. The public often interprets large volume on down bars as bearish. This is a natural but costly mistake. Volume must always be judged in relation to price behavior. Large volume with significant downward progress confirms weakness. Large volume without downward progress confirms strength. The difference lies not in the effort, but in the outcome. This principle is especially revealing when applied repeatedly. A single instance may be coincidence. A series of such occurrences establishes a condition. When the market repeatedly absorbs heavy selling without breaking support, it is telling you that supply is being transferred from weak to strong hands. Observe also the location of these effort versus result failures. When they occur near the lower boundary of a trading range, their significance is magnified. The market is being tested where it should be weakest, and it is holding. This is not the behavior of a market preparing for decline. As accumulation matures, these conflicts become more pronounced. Selling campaigns that once produced sharp declines now yield only brief reactions. Volume may even increase, yet price refuses to follow through. This is the composite operator at work, quietly completing his line of stock. It is essential to understand that absorption is an active process. Strong hands must meet selling with buying. This creates the very imbalance that the student seeks to identify. The market cannot hide this activity, it can only disguise it. Effort versus result analysis removes that disguise. However, the student must exercise restraint. Absorption does not guarantee immediate advance. Markets can absorb supply over extended periods. The presence of effort without result tells you who is in control, not when the move will occur. Only when this condition is followed by expanding results in the direction of the trend, widening spreads and higher closes on advances, does the opportunity become actionable. Remember this principle always. Price is the final arbiter. Volume provides the context. When effort is expended and result is denied, the market is signaling opposition. When that opposition consistently favors higher prices, you are witnessing strength in its most reliable form. In every market campaign, there comes a moment when preparation gives way to intention. This moment is not marked by excitement or public recognition, but by a subtle and decisive change in structure. Resistance, which once halted every advance, ceases to function as a barrier. It is not rejected violently, nor does it produce sharp reversals. Instead, it is absorbed. This change is among the clearest signs that accumulation is nearing completion. In a weak or neutral market, resistance behaves predictably. Each rally into a known supply zone meets selling. Price hesitates, spreads narrow, volume increases without progress, and the market retreats. This repetition conditions the public to expect failure at that level. The composite operator is well aware of this expectation and uses it to his advantage. During accumulation, resistance is approached repeatedly, not to break it, but to test it. Each approach removes a portion of the remaining supply. Sellers who are anchored to prior highs use these rallies to exit. Strong hands stand ready to take what is offered, quietly and without forcing price higher prematurely. The critical observation comes when these reactions from resistance begin to weaken. Pullbacks become shorter. Volume contracts on declines. Price spends more time near the upper boundary of the range. The market is no longer being repelled, it is being held. This is absorption in its purest form. Supply is still present, but it is no longer dominant. The effort required to contain price increases while the result, downward movement, diminishes. Resistance loses its authority not through collapse, but through exhaustion. The public often misreads this condition. Seeing price stall near resistance, they anticipate another reversal. Professionals observe something different: the inability of sellers to force price away. Time itself becomes a tool. The longer price remains near resistance without breaking down, the more supply is being removed. Eventually, a structural shift occurs. What was once resistance becomes support. This transformation does not require a dramatic breakout. Often, it begins with a modest penetration, followed by a shallow reaction that holds above the former barrier. This is confirmation not of enthusiasm, but of control. It is important to understand that absorption differs fundamentally from rejection. Rejection is emotional, fast, and obvious. Absorption is quiet, slow, and deceptive. One produces volatility, the other produces compression. Compression precedes expansion. The student must be patient during this phase. Many abandon sound analysis because the market appears dull. In truth, dullness at resistance is strength. It signals that supply is being systematically removed. Only after resistance has been absorbed does markup begin in earnest. At that point, advances require less effort and produce greater results. The market moves not because it is pushed, but because nothing remains to hold it back. Remember this principle well. Markets do not break resistance, they outgrow it. When resistance is absorbed rather than rejected, the composite operator has finished his work. The path upward is no longer contested, it is simply open. The study of accumulation is the study of patience, discipline, and correct interpretation. The market does not reward anticipation, it rewards understanding. Each sign discussed resistance to decline, diminishing volume on reactions, expanding spread on advances, higher lows after tests, effort without result, and the absorption of resistance is a piece of evidence, not a signal in isolation. Taken together, they form a complete narrative. They reveal when supply has been transferred, when weak hands have been eliminated, and when control has passed quietly to stronger interests. Until this story is clearly written in price and volume, trading is speculation, not analysis. The professional does not act because price might rise. He acts because the market has proven that it cannot fall. When preparation is complete, the advance becomes inevitable and participation becomes justified. Until then, the wisest position is not in the market, but in observation.